Long-short ETFs promise smoother returns and better downside protection, but execution is everything. Today's ETF Battles, an audience-requested quadruple header between 4 long-short ETFs. We'll break down their exposures, hedging approach, and actual results to see which ETF wins. Stick around. You're watching ETF Battles, and I'm Ron DeLegge. Welcome to our original series. We're in the midst of Season 7. So glad to have you on board. Be sure to join our community by hitting that subscribe button and send me your ETF battle requests in the comment section below. Give me your exact ETF tickers. Make it good. We could do double, triple, and quadruple headers. And again, hit the comment section below and give us your tickers. So today's program is sponsored by Direxion. And they've just rolled out 4 more brand new single stock ETFs, this time with 2x daily exposure to Adobe, PayPal Holdings, Texas Instruments, and United Healthcare Group. To explore the full lineup, head over to Direxion.com. Today's ETF contest was requested by a viewer named Max Penders, and it's a contest between 4 long-short ETFs. And I think Max sent this to us a second or third time. Resubmitting it, I think we missed the first time around, so thank you for your persistence, Max. And we've got Militia long-short equity ETF, Convergence long-short equity ETF, Leatherback, and First Trust. So judging today's matchup, we've got a duo extraordinaire, David Dierking, independent ETF analyst and outside contributor at the Motley Fool, joining us along with the Queen of Alts, Shana Sissel, with Banríon Capital Management. Great to see both of you. Welcome back.
Great to be here.
Thanks, Ron. Good to see you.
So our 4 battle categories are cost, exposure strategy, performance, and mystery. For the mystery category, you, our judges, can choose any factor or criterion that you think is crucial to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or they can opt for split decisions. It's up to them. I've got the scorekeeping duties, and at the end of the program, we will declare an overall winner. Remember that none of the battle outcomes on this program are ever predetermined or known in advance by myself or our judges. Let's kick things off with cost. It's sisters before misters. Shana, please get us started.
These types of ETFs are notoriously high in their cost, and it's a little bit deceiving. First, I'll just tell you who my winner is. The winner of this category is the Leatherback Fund, LBAY. Expense ratio of 120 basis points, spread to trade of about 4 cents. It is a good fund in terms of expenses, but I do want to point out the elephant in the room, which is ORR's expense ratio is stated at 10.91%. However, 9.61% of that is their dividend expense, borrowing cost, and cost of shorting. And I do not know who is the sponsor of the ETF or how it was done. But if you're listening, David Orr, you might want to go talk to them, because you should be able to have net expense ratio listed somewhere, because that should not include those expenses. And your management fee is 1.30. And that is a better reflection of the actual expense ratio. The costs that he is stating in the prospectus and not subtracting out as a net expense ratio after rebates is true with every long-short fund, except that it's sort of a phantom cost. The SEC requires that it be reported because there is a cost of borrowing. There is a cost of paying the dividend on a short position. That has a cost. That's real. But it's also included in the calculation for the value of the short position. So it's almost double cost. It's being pulled out so that you can see it. And everybody else would subtract it from the gross and make the net the management fee. So David Orr, whoever your legal counsel is and whoever issued your ETF might be doing you a disservice, and you might want to have a conversation with them, because 10.91% looks absolutely tragic, and I would guess is a huge problem when people look at the ETF and to consider it for investing.
Well, thank you for doing that extra layer of digging on our behalf. And of course, David, or if you're watching, definitely take Shana's advice. Thank you, Shana. Let's shift now to David. David, what's your take on cost?
Well, I'm thankful you clarified who you're talking to. I thought you were yelling at me there for a second.
Oh, yeah, that's right.
I
didn't want to confuse David's.
Yeah. No, I had nothing to do with the expense ratio. But I agree on cost. LBAY has the lowest expense ratio. I would just point out FTLS is a little higher at 1.38%, but it's also a fund that has about 2.2 billion in assets. So liquidity and tradability is going to be a little better with that one. But I agree. I'll just go with the lowest cost on this one. I'll go with LBAY as the winner too.
That takes us next to our next category, which is exposure strategy. So this is where we really get to the nitty gritty of what these funds do. And Dave, you're still up, so break it down for us.
Yeah, these are four pretty different funds as far as how they approach their strategies. ORR is really more of a highly active, high turnover, high concentration ETF. So it's really more of a high conviction position. It's got, I think right now about 45% of the fund is short in QQQ and IWM. So it's really taken some more concentrated bets in its long short position. CLSE, a little more of a traditional long short strategy. It pretty much shorts a lot of the expensive stocks, a lot of the lower EPS growth names, and it's long more the undervalued, less overpriced names. So kind of traditional in what you might expect out of a long short targeting strategy. LBAY is the one that has more of a yield focus, which you don't see too often. It's got a current yield of about 3%. Its 12-month trailing distribution yield is 5%. And it does that because it's focusing on companies that pay dividends, execute buybacks, or paying down debt. So you get more of the traditional long-short strategy, but it's focused more on, dividend-paying stocks. So you get more of a yield there. And then FTLS, kind of a more traditional equity strategy as well. It's typically about 90, 100% long, 0 to 50% short. So you've usually got about a 50 to 75% net long position in that one. But for me personally, I'm going to call CLSE the winner on this one. I kind of like personally the more traditional long short strategy. I like the fact that it's going long a little more of the value names. I think those are probably a little bit of better play right now. I think for the most part, just the sort of traditional aspect of it works for me. So I'm going to call CLSE my winner.
Shana, you're up next. How do you see it when it comes to exposure strategy?
So David kind of alluded to this, and I'm going to build on it. But this is the problem with long short being just a catch-all category. So these four funds are basically the equivalent to comparing a global fund with a large cap growth fund, with a large cap value fund, with a core fund. They literally are different categories completely. They just all happen to be long short. So the categorization by the Morningstars of the world is to just throw anything long short in the same category. And this is why it's so hard to kind of figure out what to invest in long short. Because I could argue that you could own all four of these and have a really nice mix of funds, just like you would if you threw a value fund, a growth fund, a core fund, and an income fund together in your equity portfolio. It's the same concept. So to me, it's a tie. And I'll just elaborate a little further on some of the things that Dave mentioned. But ORR, one of the interesting things that they do is he tends to go long developed markets, global, and that can include US, but not always. But he always only goes short US. It is very active, so taxes are a concern. This is probably a fund that you would want to pay attention to the tax consequences of the movement in an active fund. I know many people talk about ETFs don't have tax consequences till you sell it. Active ETFs don't work that way. So just FYI. It is worth noting that the background of the PM of that fund is the only actual person who runs hedge fund money next to it. So this fund is part of Militia Capital, which runs a very large hedge fund. And so this is the ETF version of that hedge fund. And the other ones are a little more quant focused, definitely not somebody who has being run by people who have experience running hedge fund money. And they all have their own value. As was pointed out, CLSE is a little more focused on dollar cost averaging. I think they use DCF for their long positions. They have a number of quant overlays, and it has like a mix of quant and fundamental. LBAY has an option writing overlay to it for income production, but is very focused on going long dividend income. It can invest in REITs, it can invest in MLPs, it can invest in BDCs and any other yield component that is not, quote, fixed income. FTLS is a much more core, it's very quant driven. And they're all just extremely different. So I don't have a winner in this category. I just want to point out that you could actually own all four of these and they would actually work nicely and complementary to each other.
Thank you for that analysis. That takes us next to the performance and yield category. So let's take a look at this, Shana. How do these funds compare?
Yeah, so it's all over the place. Like every time period has a different outperformer. And that's a reflection of the fact that they're doing all sorts of different things. I would say the most volatile is ORR, but ORR also has the shortest track record. It was launched in January of 2025. So it has just over a year. For the 1 year period, the top performer is CLSE, followed by ORR. And then LBAY and FTLS, being more conservative and more focused on downside protection, do not have as strong because they're less exposed and making an active bet for equity beta. So they're just going long short with the focus on protecting on downside and lowering vol, where the other two are looking to actively add alpha on both the short and the long side of the book. If you look at the year-to-date numbers, though, CLSE is still ahead. And second is LBAY. So again, it's kind of all over the place. The worst performer year to date is FTLS, but in the last couple of months, because the equity markets have done poorly, it's ORR. So it's all over the place. There's no clear winner. I threw in CBLS, which is a firm that I'm very familiar with. They work with Banríon, so I just wanted to look at it from a comparison. So I'm going to throw it in as a wild card, not necessarily because I think it's a better fund, but I just kind of wanted to see how it worked in the mix because it is going about its long short differently. That one is the best performer beside CLSE year to date. It is the best performer, but it doesn't do as well over the 3 years. So it's kind of all over the place. It's a reflection of the fact that they're all taking the strategy in different directions. And for that reason, I really don't have a winner. But if you absolutely required me to choose one, I would say the one that's the most consistent is CLSE. Okay.
Well, thank you for that analysis, Shana. Dave, you're up next. How do you see it when it comes to performance and yield?
Yeah, pretty much the same. It's tough to pick out a real winner in this category just because, like Shana said, the strategies are all different, so the returns are kind of all over the board. But I agree that I think CLSE would win this category for me just based on the actual performance numbers. But again, this is a real good example of why you shouldn't look at past performance to try to judge how it's going to do in the future. If we this market rotation that we've seen this year, if it continues favoring dividend payers and value stocks, then, CLSE has been a winner in the past. It might be the worst performer next year. We just don't know. But we'll keep it simple on this one. Just look at the actual numbers. CLSE is the winner.
That takes us next to the mystery battle category, where our judges surprise us with what their specific factor or thing that they feel is important to this battle. So Dave, what is your mystery battle category? What is it, and which of these ETFs wins it?
Yeah, my category is kind of going to piggyback off of what we've been talking about already. Just, I guess I labeled this category return attribution just to kind of see what's driving the returns on some of these different strategies. ORR is, you get much more influence from the short side of things with the heavier bets. So the long side of the book is a little more diversified, but again, as Shana mentioned, definitely more on the global side. So your return is really coming from the success of those more concentrated bets. CLSE, you're really, I think, getting more of the manager skill there, because the performance and the returns are coming up from both sides of the book, both the long and short positions. So risk-adjusted returns look pretty good on this fund historically. LBAY, again, the yield-focused one, you're getting the majority of your return historically from the yield on that fund as opposed to the capital growth. So obviously in risk-on markets like what we've seen in recent years, that can be a drag on performance. FTLS is a little more unusual that it's got about 400 different holdings in total. So it kind of makes it a little bland almost to the point where I think with long short strategies, you might want something that makes a little more of an aggressive bet. You get something that's a little more generic when you have that many holdings in a long short strategy. So as far as my winner, I'm going to go with CLSE again. I just think I like the risk adjusted returns on it. I think the managers have shown that they do well both on long and short positions. So when in doubt, I think you go with manager skill. So I'm going to go with that fund.
Thank you. And Shana, you're up next. How do you see it in terms of what your mystery factor is and which of these ETFs wins it?
I'm going to start by saying that ORR to me is not a diversifying alternative, even if it is in the long short category. I view that as something that I might use instead of a long only fund in my traditional equity, because it's juiced the same as a traditional equity, and it's going to give you equity-like returns, and it has a lot of equity beta exposure. And what you're buying there is the manager's skill in adding alpha through shorting. So to me, that is in its own category, and it's not an alt in the sense of I would use it as a risk management tool, because it is not going to manage or reduce risk necessarily in equities like the others. So I'm just going to start there. And the second thing I'm going to say is when I look at long short equity funds and I'm going to use them as a risk management tool, I want the number one focus objective of that product to be a reduction in overall equity volatility and downside protection. And of the funds in this category, there's really only two that have that as an expressed objective in their investment strategy. And that's CLSE and LBAY. Now, when I look at the two, the one that I think is more skilled in executing that objective is CLSE. So for me, CLSE, if I only had to choose one long short equity fund that I would put in my alternatives bucket of my portfolio, it would be CLSE. I am also going to throw a wild card in here at CBLS because it also has similar attributes to CLSE. I know the tickers are kind of similar. They're different firms. CBLS is the CLOW hedged equity ETF. It is also actively managed. It has the same similar risk objectives. Similar to ORR, CLOW is part of a hedge fund. So there's a lot of hedge fund money being managed around it. And so I think that's somewhat of an advantage. But it is looking to kind of mirror what CLSE is doing. And at times has outperformed, at times it's underperformed, but sort of has the same movements in their performance as CLSE. And so for me, when I look at this and I think about how I would use long short in a portfolio as an alternative diversifier, I throw ORR out. Not that I don't like it. I might actually use it, just not as a diversifying risk management alt. It would just be part of my equity bucket instead of maybe a global equity fund. I would use CLSE to kind of fill that. I like to call it the dial that I might turn in my alt portfolio to dial up and down equity beta. Because sometimes you do want to have equity beta, especially when the market's going right up and you don't want your alt portfolio to be a drag. And CLSE for me seems like a good tool. I just want to point out FTLS to me could have 125-25 or 150-50 in its title. And it would bring me back to the days that those funds were everywhere. It's the exact same structure as those funds were, just without it in the name. And those funds had a different purpose. But for me, CLSE is really the winner. And I will throw CBLS in here as a wild card, as something similar in the same flavor.
We've now moved to the part of the program where our judges are going to give us their overall winner. How will this go down? Shana, give it to us.
Yeah, so based on everything I've said, I don't know that I came into this battle with a clear winner in mind, but as we've gone through it, it seems to me that CLSE is my winner here. And again, CBLS is a good wild card, but I don't know that it's necessarily a winner in a battle with the other four. That'd probably be like my second choice. I do really like ORR, but not in a long short capacity. I actually think he has shown real talent. And you can see his hedge fund chops, but not as a risk management tool, not as part of my alternatives bucket.
Dave, your final chance to weigh in with your overall winner.
Yeah, I'm going with CLSE as well. I think just personally, historical performance is good. Of course, that could change in the future. I think it just provides one of the best combinations of successful fundamental stock picking. I think they have a process that's has the ability to repeat over time, even as market conditions change. I think it's just sort of the best long-short strategy of this bunch. So I'm going to go with that as my winner.
Well, our judges have spoken, and according to our final battle scorecard, the winner of today's quadruple header long-short ETFs is CLSE. That's the Convergence long-short equity ETF. And our judges made some awesome points and awesome arguments. Risk or reduced volatility, right, is one of the key things that you're looking for of the overall portfolio when you're using these types of ETFs. Some downside protection, and also as a diversifier, right? You want these ETFs to do something very different than what the rest of your portfolio is doing. That's the whole point. And I think our judges made that very clear. And also, David Orr, if you're watching, definitely get in touch with your legal counsel. Get that expense ratio information cleared up. But again, great job to both of our judges in this quadruple header of long-short ETFs. We couldn't have done it without you.
Thanks for having me, Ron. Really appreciate being here. Do an alts battle for real.
Yeah, thanks. Good to see you guys again.
Yeah, be sure to hit that description section below. We've got links to both of our judges, so get in touch. Also, hit me up in the comment section with your ETF battle requests. Give me your exact ticker symbols, and we'll take a look at it. I'm Ron DeLegge with ETF Guide. See you on the next ETF battle.